For most of human history, money was simple. You earned it, you held it, and you decided how to use it. That relationship is changing quietly, not with a crash, not with a ban, but with a transition most people don't fully understand yet. Right now, governments around the world are building something new. Digital money, not cryptocurrency, not Bitcoin, something very different. Central bank digital currencies. And what makes them powerful isn't what they replace, it's what they enable. Cash is anonymous. Once you hand it over, it's gone. Digital money is not. Every transaction represents data, a record, a trace. Supporters say this is about efficiency, faster payments, lower costs, less fraud. And technically, they are right. But systems are never built for only one purpose. Every system reflects the incentives behind it. And digital money introduces a capability cash never had: rules. With programmable currency, money doesn't just move, it behaves. A payment can be approved, delayed, restricted, or declined based on set parameters. Not necessarily because of a crime, but because the algorithm flags the activity. This isn't speculation, it's infrastructure. Governments already use emergency powers to freeze accounts. Banks already flag transactions automatically. Look at the precedents. In China, the digital yuan framework allows for expiration dates on currency, creating the technical ability to stimulate spending by forcing users to use funds before they vanish. In Canada, during the 2022 protests, emergency measures allowed financial institutions to freeze accounts without traditional court orders. In Brazil, the central bank's new digital protocols include functions that allow for administrative freezing and balance adjustments. The capability is already built. Digital currency simply centralizes these functions into one system. And that's where the real shift begins. Because once money becomes programmable, spending becomes conditional, savings become transparent, and control becomes granular. This doesn't mean a dystopian collapse is happening tomorrow. That's not how systems gain acceptance. They start optional, they start convenient, they start helpful, until opting out becomes inconvenient, then expensive, then impossible. Most people won't notice the transition at first because nothing dramatic happens. Your balance looks the same, your payments still work, your life continues, but the mechanism has changed. Cash gave you autonomy by default. Digital money gives you access by permission, and permission can be adjusted quietly. The most critical part isn't surveillance, it's dependency. When every transaction runs through a single digital ledger, that ledger becomes the economy. And systems don't need intent to cause harm. They only need incentives, efficiency, compliance, stability. Over time, those priorities reshape behavior, not by force, but by design. This is why debates about digital money often miss the point. The question isn't whether it's faster. The question is what kind of relationship you want with money itself. Because once the analog option disappears, there is no backup layer, no private exit, only the system and the protocols it enforces. This implies the margin for error is shrinking, and most people won't realize what was lost until the alternative is no longer optional. The end of cash won't feel like an ending, it will feel like progress, until one day you realize the rules changed and no one asked you.